Morning, everyone. I'm Bhavna, Community Manager at India IT 360. We're delighted to welcome you all to this exclusive session that's on wealth management planning. We have our speakers from the industry who can guide us well on this. So let me quickly introduce you all to our speakers. So Mr. Amit Gupta, he's heading client coverage, wholesale banking, IDFC First Bank. Mr. Amit brings years of experience in understanding client financial need and aligning them with the practical and wealth strategies. We also have Mr. Rahul Singh. He is the country head, private banking, wealth management, IDFC First Bank. Mr. Rahul has been an instrumental in guiding professionals and entrepreneurs on their wealth building journey with a smart and tailored financial strategies. Also, after this presentation, you can we'll take the questions. So please feel free to put your question in the chat box, and we'll take the questions after the presentation. So I'll not take much of your time, and I'll quickly ask Rahul sir to take this session forward. Thank you.
Thank you, Bhavna.
Thank you, Bhavna.
Amit, you would like to start? Yeah.
Firstly, thank you very much, all the participants. Me and Rahul, on behalf of IDFC, really thanks to India IT platform as well as to each and every participant on this particular forum to attend. So the agenda of this particular presentation is to have a wealth management and financial planning, because we all are professionals and always willing to have a financial freedom number in their mind. So me and Rahul being a strong experience of the wealth management and private equity, want to give you an insight how to basically achieve a financial freedom and a number, and what kind of number is in everyone's mind. There's a various strategies, and we are happy to discuss each and every strategy and the way to achieve that number. So we have a small presentation. Rahul will run through the presentation, and during that presentation, if anything else, you can always put on the chat box. And after that, we can have a question answer round where we can reply each and everything at our best level. Rahul, you can start the PPT.
Yes. Thank you, Amit, for setting the context. Let me just share my screen. Okay. So good morning, everyone. Thanks for joining. As Bhavna introduced, my name is Rahul Singh. I run the private banking business for IDFC First Bank. So the way we are going to do this will take about 20-25 minutes. It has a few interesting trivia questions. So we will start with that. And I would encourage all of you to use the chat box to answer your questions. And then post that, we have 2-3 short videos to just help you with some understanding of how we think about wealth management and financial planning. And then few other slides on how the bank can help you in these goals. So let's start with some trivia questions. It's just to, on a Saturday morning, all of you have taken effort to join us. So it'll just help you, get some fun facts. So let's start with the first one. Can some of you name the first ever company or enterprise to have issued equity shares? Amit and Bhavna, you'll have to help me. I'm not able to see the chat box, but if you can just see that.
Sure.
Have you got some answers?
Tata Steel.
Okay, this is all over the world. Okay, not only in India. All over the world.
Yeah. And then it's not India. It's basically across the globe.
Yes. Maybe 10 more seconds and then we can just get to the answer.
Great, Baldev. Just hold the chat box.
Okay. So I think we've got some answers, but let's get to the correct answer is the Dutch East India Company.
Kudos to Baldev, Rahul. Very few people know that. So it's a great thing.
Okay.
Baldev Dutch East India.
Dutch East India Company, first equity shares anywhere in the globe was issued by a Netherlands company in 1602. And you can see of course, those were the high interest rate days. So the first 50 years that shareholders made 16% CAGR, so which is a very, very fantastic return. Okay. So that is the first question for you. Let's move on to the next question. This I think should be easier. Name the country with the most number of companies listed on the stock exchange, the maximum number of listed companies. Which is the country? Please use the chat box. Amit, have you got some answers?
Yeah. I got an answer. I think few of them have given the correct answer.
Okay.
Obviously, the two name comes.
Yes, I think you all of you are very close. I think this is slightly easier. So the answer is India with 5,000, approximately 5,500 listed companies, followed by US about 4.5, and then China about 4,000.
And
So
the good thing is, Rahul, that all have given the answer among the top three options, either the
excellent.
India,
So
US,
of
China.
course,
So the people,
so
our
it
audience
shows.
is strong in the equity market, it means.
Correct. It shows the depth of the Indian markets. Of course, US is also equally good in terms of the depth and the breadth. Because if you see even some of the other emerging economies like Brazil, Indonesia, these are very large emerging economies, but their stock markets are dominated, even Russia for that matter. It's dominated by few industries, few firms. So India and the US and to a certain extent China are the only countries where you have a very wide range of companies in terms of industries, in terms of the number, so that allows you to invest, with a home bias. Okay, let's move to the next one. This should be slightly difficult. What is the return given by Chinese equity market, the Shanghai Composite, in the last 15 years? CAGR. Oh, no, not CAGR, absolute return I'm looking for.
Absolute return in
Absolute
the
return,
15-year bucket.
15 years.
So in a way, from 2010 to 2025.
Correct.
Great.
Have you got any number?
Yeah.
You'll be surprised by the answer, actually, all of you.
Few are not surprised. Few are aware of that, Rahul. They
Okay,
know
okay.
quite well.
So people are very, we have to be extremely careful in our presentation. People are
Right.
quite knowledgeable in this group. Okay, so let's go to the answer. It's -8%. It's basically flat in the 15 years. As you can see, India, the markets are up by 6.2 times in the last 15 years, and Dow Jones, US market, is also up by 3.2x. So the point here is that sometimes we get carried away by the news and all of that, but if you really go deeper, in China, the market is dominated by state owned enterprises. The banks, the state owned banks dominate. The state owned real estate companies, construction companies, they dominate the stock market. So the returns are not, it's not like India or US where it is a more private enterprise. So China is a very, very state led economy, and that's why the stock market returns may not necessarily align with the GDP growth, unlike US and India. In India and US, it is closely aligned to the GDP growth, where in China, the GDP can continue to grow, but the stock market may or may not.
Basically controlled by the state.
Okay, absolutely, yeah. Next one, last two questions. So this also should be easier. Which was the largest economy in the world before the industrialization period, which is around 1800, when the industrial revolution happened in Europe around that time. After that, of course, Europe and America started doing much, much better. But before that, which was the world's largest economy? Any answers, Amit, on that?
Yeah. Most of the people have given the right answer.
Correct answer. Okay. So this is also, as I said, it's
That is
easier,
India.
but you will still be surprised by the number. Okay. Indian subcontinent, the India, Pakistan, Afghanistan, Bangladesh, Myanmar. Earlier, the undivided
Bangladesh.
India contributed nearly one-fourth of the world's GDP, and you'll be surprised the undivided Bengal, which was nearly 10% of the world's GDP. And of course, over the next 200, 300 years, we went down, and the Western countries went up, and now we are slowly back to about 4 or 5% of the world's economy. Okay, and hopefully in the next 20 years we'll get closer to 10-15% of the world's GDP. Last question. This also, if you can get this answer right, where did the bull and bear market get their names from? Why do we call a bull market and a bear market? How do you get that name? It's a very intuitive answer, but you can let me see what people can guess or not.
So far, no guess.
No guesses. Okay. Okay, so I think it's if you this is related to how these animals attack. So it's a symbolic representation. So bull usually attacks with the horns up, and the bear swipes the paws down. Okay, so bull market means the market is going up, and bear is going down. So that's how it name first came into being. The way these animals attack. Okay, so with that, we'll just the trivia session ends. We will start our presentation. I hope it was a good introduction to the session to keep everybody awake. So let's start with three short videos. Okay, the first one is how to make smart investments. Okay, we run a IDFC Academy, and I've picked these videos from that. These Some of these videos are available also on our website. You can go through them, but I just picked three of them which will be suiting this audience. So let's start with the first one: how to make smart investments. Amit, you can just confirm if it is
Yeah,
playing.
How to make smart investments.
got it.
Today, there are many ways to save money. But did you know that you can even make money grow? Yes, you can by investing. Investing wisely is a key to earn better returns. And this can help you to achieve your financial goals in a timely manner. Investing means buying something with the aim of earning a return on it over a period of time. Stocks and bonds are a form of investments. Buying property, land, and providing money to startups are also investments. So, are you ready to start your investing journey? Just like savings, the earlier you start investing, the more time your money has to grow. The first step in your investing journey is research. It is important to do a thorough risk and return assessment before investing. So, if you have a wish to invest in the stock market, also known as equities, it's first important to understand how that market works. By gaining knowledge, you will be able to make better investment decisions. If you do not have the time to do the research yourself, you can also consult a professional financial advisor. More hands-off investments also exist, such as mutual funds. Once you start investing in a fund, you need to be consistent with your payments to let your investments grow. Bonds are also a low-risk form of investing that can get you some healthy returns. Diversifying your investments is a great way to reduce risks and increase the chances of success. Avoid investments that offer a get-rich-quick opportunity. If something sounds too good to be true, it probably is not true. The other key practice is to learn constantly about the changes and new developments in the market to discover new investment opportunities. Doing periodic reviews also help to rebalance your portfolio from time to time and reduce your risks. Wait no more. Start investing. It's the best way to grow your wealth.
So I hope this was useful. So we get into our second video, investing for different risk profiles. Because so saving, the first video was trying to tell you the difference between saving and investment. Saving is the first step, but investment is allowing your portfolio to do better than inflation. Uh, and then we come to different risk profiles, how different risk profiles have a different uh, investing options. So let's go with the next video.
Investing for different risk profiles. Investing your money allows your funds to grow much faster rather than leaving them idle. There are many investment avenues available today. But before you make a financial investment, you need to understand your risk profile. Your risk profile is your willingness and ability to take risks. How big a setback you can handle decides which of the three risk categories you belong to: aggressive, moderate, or conservative. Aggressive category offers high returns, but it is for people with a high risk tolerance. Moderate offers moderate returns and balances out the risk. It is for people with moderate risk tolerance. Conservative offers stable returns and is for people with low risk tolerance. Once you know your risk category, you can choose the right investment options for yourself. Direct equity, also known as stocks, can give you great returns if the company you invested in does well. However, the stock market can be volatile, and this investment option is for people with an aggressive risk profile. Mutual funds are for both aggressive and moderate risk profile people. These funds pool money from multiple investors and invest it into a diverse portfolio of stocks, bonds, or other assets. Investing in real estate requires you to purchase property or land. With this, you can get returns via rental income and property value appreciation. The real estate market may be unpredictable and illiquid, depending on market conditions. Fixed deposits are a low-risk investment option offered by banks and NBFCs. They provide a fixed rate of interest on the deposited money over a specific period of time. Government or corporate bonds are another conservative investment option that offers stable returns. Here, the government and companies pay you an interest over a time period. To choose the investment instrument that suits your risk profile the best, do in-depth research and understand the investment instrument completely. It is a good idea to not invest in a single instrument, but to aim for diversification. Consult a professional for advice, especially when it comes to risky or complex investments. Remember, knowledge and precaution will help you maximize your returns. Be patient, since investments are all about long-term gains. Embark on your investment journey. Start small, learn continuously, and be disciplined in your approach. Investments can pay off handsomely when you invest wisely.
Yes, so it spoke about different risk profile. There are so many products available in the market, but it's important to understand your need and based on that invest. The last video before we get into the slides.
What is portfolio diversification? Have you heard of the phrase, don't put all your eggs in one basket? Well, Mr. Sharma certainly has. And that's why, now that he has decided to make investments, he has decided to diversify it across a variety of assets, such as stocks, commodities, bonds, mutual funds, and more. This way, he can reduce his risks and soften the impact in case any of his investments performs poorly. To begin with, Mr. Sharma considers his risk tolerance and calculates the investment period required, which involves active participation of the investor to achieve his financial objectives. Now, he is ready for portfolio diversification. But what exactly is it? Let's find out by observing how Mr. Sharma goes about it. There are two broad ways of portfolio diversification: direct and indirect diversification. Mr. Sharma first opts for direct diversification. It is ideal for people who are well versed with how the market functions and are ready to do intensive research before making their decisions. After a thorough research, Mr. Sharma does asset allocation to decide exactly how much he wants to put into stocks, bonds, gold, real estate, and cash equivalents. Next, Mr. Sharma decides to buy stocks in companies in Spain, the UAE, and Thailand. This geographic diversification helps Mr. Sharma to tap into unique opportunities offered by each region and economy. Within these different geographies, he picks a mix of companies operating in different sectors, such as financials, healthcare, consumer discretionary, technology, education, energy sector, and others. This industry and sector diversification allows Mr. Sharma to benefit from the growth potential of different markets. Even within these sectors, Mr. Sharma opts for three different companies to benefit from individual securities diversification. This way, Mr. Sharma's portfolio remains safe even if a company defaults in its operations. Mr. Sharma wants to be safe from short term market fluctuations too. So he uses time diversification. He refrains from investing a lump sum at one time and increases the investment amounts gradually over a period of few months. Mr. Sharma realized that direct diversification was taking up too much of his time. Thus, he opted for indirect diversification too by investing into a mutual fund. Here, Mr. Sharma would not need to participate actively in investment decisions. Mutual funds are handled by professional fund managers who are experts in diversifying money according to investment objectives, as specified in the scheme's information document (SID). Mutual funds are divided into equity, debt, and hybrid funds. Equity mutual funds are further divided into large, mid, and small cap. Investing in mutual funds offers Mr. Sharma a chance to invest in commodities and international assets too. Mr. Sharma is happy with the way he has diversified his portfolio. He is aware of its benefits, but also knows that going overboard with diversification can complicate matters. Worse, it can increase his risks. Also, he understands that diversification does not mean that the risks are entirely eliminated, nor is it a guarantee of making profits. Like Mr. Sharma, remember a strong, diverse portfolio takes time and research to build, and then constant rebalancing to maintain it. So, it is best to consult a financial expert too. Get started now.
So thank you for patiently listening. So we'll get into few slides we have. So we'll speak about how to gain financial independence by talking about few concepts. So on this slide, I would invite Amit Gupta to just take the audience through this very important slide. Amit,
Yeah.
over to you.
Yeah, thank you, Rahul. This is a very important slide, and I myself is surprised by looking at the data. So if everyone can see that in 1947, the average life expectancy was 32 years, which is a big surprise to many of the audience, and which has over a period of last post-independent increased to 70 years in 2024. So I don't know why whether people are able to understand the meaning. It actually means that today the average life of every individual is 70 years, which includes the early mortalities also. So there are kids who born, they might not able to survive for 6 months, 1 year, or up to 5, 10 years. Including those, the average life today becomes 70 years. And we expect, as per the data, that the average life in 2050 will be 80 years for the man and 83 years for the woman. It means that it is very important for each one of us to plan their retirement, because today the retirement age as per the government and in general is around 58 years, and people are willing to have an early retirement or in a way early financial freedom. So when you talk about early financial freedom, that say if you wanted to work for 25 years, so how I see the life, that the first 25 year we will born, we will grow, we will do the studies and start our career. The next 25 year is the time when we want to earn, and most of the professionals wanted to do their own passion. And the last 25 years, that is from 50 to 75 years, is something which people wanted to do their own passion, whatever they wanted to do in their own life. So today we have to plan that 25 to 50 year so smartly that the rest 25 year we can plan accordingly to our own life. On the right side, there is another data that save the short term rather than the long term. So most of the people, we always prefer to save on a short term basis. Like, I want to buy a car, I want to buy a house, I want to buy maybe a luxury products. But we never plan for long term. And when we reach closer to 45 and 50, then we start thinking. So on one end, most of us wanted to have a early financial freedom, but we plan slightly later of the that particular time period, which will, I think, have another impact. So these are the few data which will, I think, give you a broad sense. And another thing, we have to plan the medical, because if you see on the right side, the medical inflation in India is going at a rate of 14%. So in India, the most important thing is that we have to plan two, three things. One, our retirement. Second, we have to plan our medical. So these are the critical aspect which will basically give a long, basically a privilege for us how to plan for our future. Now Rahul will take the next slide, and then we can have a question answer how to plan all those aspects.
Absolutely. Thank you, Amit. So I would like to add one point is that I think traditionally, if you see our parents' generation, that the concept of retirement planning was not there because one, people were living, typically for 65 or 70 years. So you need to only plan for 5, 10 years. Most of them were working in government jobs, which allowed them to get pension. And the third is that they expected their children to take care of them. But now you can see the number of households, number of members in the family are falling. So some people are either having no kids or one child. So it's very difficult for a child to support their parents for 20, 30, 40 years, which was earlier possible because you had bigger families and shorter lifespans, right? So it's important to plan for your own retirement, and we can help you, give you an individual plan. I have 200 private bankers in my team spread across 30 locations in the country. We can help you with that. Let's move. It's a little bit about, is your money working for you? Okay, so let's do a very quick quiz. If your monthly expense is 50,000 today, how much will it be after 25 years? Let's see the answers, and maybe you can use the chat box to see which one of this is correct out of the 4 options. Is it 2 times? Is it 3 times? Is it 4 times? Is it more than 4 times?
So in a way,
Amit, you
Rahul
can help
wanted,
me with the chat.
in a way, Rahul wanted to say that if we have expenditure of 50,000 and with the inflation adjusted, what will be the number after 25 years? Am I right, Rahul?
Yes, absolutely. Yeah.
So she told 3 times. Most
Okay.
of the people are 3 times.
3 times. The answer is for more than 4 times. You will be surprised with this number. After 25 years, 50,000 is will be worth 2,14,000 because of inflation. So if your monthly expense is 50,000 today, after 25 years, it will be 2,14,000. So it's it dramatically increases. Let's see one more thing. If you keep 50,000 in a box, which is, just as a hypothetical question, you keep it under the mattress, what will be its value after 25 years? Is it less half, less than one third, less than 20,000, less than one fourth?
Yeah.
Any people
So
in the
answer
chat?
lies on the first question, actually.
Okay. Yeah, absolutely. Yeah. So it's the same thing.
Yeah.
So less than one fourth, the value will be 11,000 rupees. So the point it is trying to say is that if you keep money, of course, nobody keeps money in the mattress, but it's just to make you understand that even if you put money in savings account or a fixed deposit growing at 4, 5, 6%, it just barely covers inflation. So if your money has to
Keep going.
increase real real rate, which means above inflation, and over longer periods, 10, 15, 20, 25 years, even 1 or 2% extra return per annum can create a dramatic impact. Okay, so that's the idea of this slide. Effect of compounding, again a more dramatic example, just to give you. If you start with 1 rupee today 1 rupee, and it doubles every day. So tomorrow it becomes 2, third day it becomes 4, fourth day it becomes 8, and so on and so forth. What will be the money at the end of 31 days? Any guesses? Is it 50 lakhs, 1 crore, 2 crore? Any answers on the?
No, not yet.
Not yet.
Yeah.
We
One of
started with
the-
1 rupee, mind you, not 1 crore. Okay, 1 rupee. So 1, 2 rupees, 4 rupees, 8 rupees, like that. 31 days. You'll be surprised, because human mind is thinks linear. We can't think compounding. It's very tough for human mind to, because of millions of years of evolution. Our mind thinks linear. So let's go to the answer. You'll be surprised with this number. Day 1, you see 1 rupee. Day 10, 512 rupees. Day 15, 16,000 rupees. Day 20, 5.2 lakhs. 1.7 crores. 13.4 crores. 53 crores. It will be 107 crores at the end of 31 days. So again, this is a hypothetical example, but just tries to tell you that what is the power of compounding. If you start early, you can see on the table on the right hand corner, bottom corner, that just by starting early, you can see the impact. If somebody starts at 25, okay, and does only 72 lakhs till 55, and same here, somebody does for 10 years, the impact is dramatic. Investment amount is same, but just because you gave more time, the accumulated amount is 7 crores instead of 1.4 crores. Okay, so it's important to understand this impact, and that's why I mentioned even 1 or 2% more return per annum over a 10, 15, 20 years can create a dramatic impact on your portfolio. So how do we use some of these things to really look at your portfolio? So we follow something called a bucket strategy. So typically you should have three buckets for your retirement: cash bucket, income bucket, and growth bucket. Again, the percentages which I have mentioned here are symbolic, so it can change from people, person to person. So I've put 40% here, 30. It can vary, and as I said, it will be very individual. So cash bucket typically is for anything which is less than 2 3 years, which is your emergency needs, medical, so typically fixed deposit, bond, savings account, health plan, term plans, all of that will help you in cash bucket. If you want income bucket, which is to generate cash flows which will meet your lifestyle needs, you need to invest in bonds, debt funds, dividend stocks, SIP, mutual funds, guaranteed return plans, all of that. The typical returns in cash bucket is 7 to 8%, and income bucket is 8 to 12%. Then whatever money is left, which will compound, which you want to leave a legacy for your second generation or as a buffer for your future uncertain needs, is the growth bucket, which will typically give you more than 12%. This includes real estate, equities, gold, mutual funds, PMS, all of that. So typically, these are for 10, 15 years and above, and the returns are typically higher. I've also listed some financial priorities. Of course, all of this can be, slotted into these three buckets. So it's important to understand how do you want to allocate your money in different buckets, because that sometimes the mistake which we do is that we just look at, I have 50 lakhs to invest and this is a best return product, and then I will try to match that. But that's not a good strategy. You should look at a portfolio that I have 2 crores to invest. Can I divide this 2 crores into these three buckets, which will take care of my three broad needs, which is short term, medium term, and long term. Okay, let's move. So a little bit about our bank, what all we can do. So this was more of concept of investing, and next few slides will be on our bank. So as I said, I represent the private banking, and our branding is IDFC First Private is the branding, where we help clients meet their financial goals. We offer almost everything, as you can see from here. Almost everything we offer, what you can think of in terms of lifestyle benefits, wealth management, dedicated RM team, credit card, everything, whatever, banking, all kinds of things we offer. More details we can discuss, as and when we get along. We offer bespoke wealth management solutions. It's tailored to each customer. It is not a one size fit all portfolio.
Basically, just to add on Rahul point on the private banking side, the expertise of IDFC Bank, that we give a specialized service based on the risk profile of every individual, because every individual will have their own risk profile. So Rahul will have a team of more than 200 people, and every private banker will guide each and every individual basis their liquidity requirement, their requirement of particular retirement planning, and their own risk profile. So that is one of the beauty, and we also offer along with it all kind of products, including any kind of a loan requirement, credit cards, any kind of wealth management advisory, and not only restricted to mutual fund. The biggest thing which I wanted to add, that as a wealth management, we in the private banking advise HNIs and a senior professional CXOs to invest in startups, to invest them in unlisted stocks, to invest them in AIFs, PMS. So it's basically a one-stop solution for each and every individual who is having a CXO level or a HNI profile. That is what I wanted to add along with the Rahul.
Yes, thank you, Amit. So, as you can see from this slide, we offer almost everything: accumulation, preservation, expansion, transmission. That you want to transfer wealth from one generation to another. We have solutions for everything. Okay, and it's a one-stop shop. We also do, as Amit mentioned, alternate investments. So we do unlisted, we do pre-IPO, post-IPO, PMS, offshore, anything you want to invest outside India. We have Gift City. So we give you all kinds of the entire ecosystem is available for you to take advantage. Let's move. Also have partnerships. So it's think of us like a general physician or a family doctor. You come to a family doctor, you consult them. But let's say somebody needs a knee surgery. So the family doctor will not be able to do it on their own. But I will get the best knee surgeon available in the market and help you. So you can see from this slide that right from Dhruva advisors for tax, for offshore, we use Philip Capital, and we have signed up with a company called Crystal AI. I mentioned about Gift City. We have pre-IPO investing with 3-4 different companies. We have estate planning. We have 3 companies which help us and our clients in estate planning. If some of you are running your own businesses, if you want to raise capital, I have 3 or 4 partners who can help you raise capital on debt as well as on equity. So everything, I will get the best people, because for me, I am on the side of the client. So I am not a product manufacturer. So I don't have any mutual fund to sell you. I don't have any PMS to sell you, but I have partners. I can get the best mutual fund, the best PMS, the best advisor for you to get your needs done. So just think of us like a family doctor or a general physician, and who can get the best in the market for you, your solutions. Okay, so that's how you think about us. We have a proprietary tool called Wealth Index Navigator, which we use. We use asset allocation, we use regular portfolio rebalancing, we do in-house research to design your portfolio, and then which helps us in giving an outperformance. As I can share, the last 3 years, our portfolio, if you had invested with us, you can see if you had only mutual fund recommended by us, your portfolio would have done 2.6% better than the market. If you had done mutual fund plus PMS plus AIF portfolio with us, it would have given you 6.3% better return than the Nifty 500. So it generates alpha, and it's a proven model. It's an in-house model, and any one of you wants more in detail, we can once we speak one-on-one, we can have a more detailed discussion on how we do this. Also, there's a proper methodology. It's an in-house tool called Value Index Navigator. Our DIY, if some of you are our customers, you would have seen our app. Our app is probably, how do I say? We compare ourselves to more like a fintech. Our app is closer to what you will see in Grow, Zerodha, or Upstocks. It is not, it's very, very far away from a traditional banking app. If you look at HDFC or some of the other banks, the apps are very, it is not the user experience or UI is not closer to a fintech. It's more traditional banking. Our app, very, 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 very high tech. Just to give you, of course, whatever you see on the screen, you can do all of that. But also, we have 3 unique features. Okay, one is called account aggregator. If you have our app, and you have multiple bank accounts with the same mobile number, you can see everything in one place, all your balances at one place. So that's called an account aggregator. We also have a mutual fund aggregator, which means even if you don't invest through us, if you activate that account, the mutual fund aggregator, you can see all your portfolios wherever you invested with the same PAN number in one single place. That's called the mutual fund aggregator. The third feature we've recently launched is called the net worth aggregator, which means all your PPF, EPF, everything which is there, you can see all those things in one place. So I would recommend, if you don't have an account with us, just contact your nearest branch or contact us, and then we
Contact
can.
us, we will approach. Right. And just to add on Rahul point, thank you, Rahul. I think it's a great point you have added. Even I have started using this particular feature where I can see, say, I'm having 5 saving account, and I'm largely using my bank saving account, but there are other saving account which are also there. So the beauty of this app is that you can see the balance of each and every account. Similarly, on the mutual fund, we at times go to the cash report, NSDL report, plus we can also go to the direct equity and a mutual fund. This particular app consists of each and every feature in a single window. So I can open a single window, I can see what is my total portfolio today, and with the safety that I cannot sell and purchase from that. I can see my all portfolio there. So it's safety also, and it's a consolidation of all kind of financial investment in one single particular app.
Perfect. Thank you, Amit. I think we are nearing towards the end of the presentation. I'll just maybe just highlight few things. We partnered with Hurun for the last 3 years. We are honoring India's top 200 self-made entrepreneurs. This is the third season. Okay, Hurun is a very well-known brand for the India's rich list. So this is the top 200. It goes well with our theme. We are a startup bank. We are a new bank. So we want to reward people who are self-made entrepreneurs, and we have been doing it for the last 3 years. We also, some of you are part of a startup ecosystem. We also have a very unique property called Leap to Unicorn, where we have partnered with Money Control and CNBC TV18, where we invite applications through our website, nearly 5,000 applications every year. Then we use an expert agency to filter those startups, and then we slowly move towards the final, where every year around 20 startups are rewarded. We also create an ecosystem where not only banking, but we create an ecosystem where these startups can get access to venture capital, private equity, family offices, and also get a platform to showcase their ideas and ability. And of course, we also help them in banking. So we have very unique products for startups. We have a separate startup banking team which help this. So right from your bank account to your credit cards to your filing your taxes, all of that, we've created an ecosystem of. If some of you are interested in banking with our startup team, then please reach out to us and we will help you with this. Okay.
So yes, Nishant is asking, please suggest some mutual fund to invest.
So it's a very Mr. Nishant, it's very, very individual specific. So we can suggest, but I would recommend that if you can have a chat with my team members, and we can, because one fund which may be good for you may not be good for others. So it's a very specific advice. So I would recommend that you look at having a one-on-one session, and to get this. We also have a model portfolio, so it doesn't need, if you have some amount to invest, we can create a model portfolio based on your risk profile. But it's very difficult to name a particular fund because we have a large group here. Okay.
And just to add on Rahul's point, Nishant, I think question is good, but the issue is that any particular mutual fund is always depend on your individual risk profile. So you can always willing to invest in the large cap or a mid cap or a small cap. People want you to invest only in Nifty. So for every particular category, there are some particular fund who can perform better. So that the team can, I think, guide you basis your own risk profile and on your basis your own kind of the investment and the return expectation.
Sure, sir.
Yes.
So the next question that we have got is from Mr. Ninand. Can you give a real life example of one of your customer as how partnering with you helped achieve their financial goals?
Yes, I mean, we have many examples. We manage about 8,000 families, 54,000 crores of assets. So there are many examples where people have used our services for their children's education, their retirement. Even just a lot of wealthy people need not be saving for a particular goal because they have enough money, but just the portfolio to grow. So we have so many such examples, and we do a quarterly portfolio review to see that if you put a goal to us saying that this is what my goal is, and then every quarter we assess where your portfolio is growing. So it is there. We have many such examples.
Okay. It's a very good question from Mr. Akash, that what is the idealistic allocation one should have in gold, real estate, liquid investment? So yeah.
Yeah. It's a very, again, a very individual
Very good.
question, but it depends on, so if you are, it depends on your risk appetite, objective. So let's say if you're looking at 8% return, then a portfolio with even 20% into equities and 80% into fixed income can meet your goals. But if you are wanting a 12% return, then a 50-50 portfolio will be better. If you want more than 15%, then closer to 80%, 90% in equity will work. So there's no ideal number. It depends on your risk appetite, the time horizon, the return expectations, all of that.
Coming to your point, so we always discuss that at the age of 25, that the ideal thing is that you should invest 25% into debt and 75 into equity. And as and when you grow at the age of say 50, can be 50-50, or at the age of 60, you can invest 60% towards debt and 40 equity. But these formula get changed over a period of time. So as Rahul mentioned, because every individual has his own risk profile, and people expectation from the investments is keep growing. So today, even if you see any young childrens, they wanted to have, other than their provident fund, wanted to invest 100% of their money into equity because they have a huge appetite to take a risk. So the allocation can always be discussed, Nishant basis, maybe your individual risk profile, at what age you are sitting, what kind of corpus you are looking, and what kind of your expectation from the returns.
Great.
Okay.
Thanks, Amit. Yes, Bhavna, let's move to the next question.
Sure. So the next question that we have is, what is the minimum ideal fund size someone should have to take your services? Is it a return in after inflation adjusted and your fee? So someone is,
I
yeah.
will take that question. So we have
Okay.
three. So Mr. Vijay Kumar, there are three. Uh, no, Mr. Ashutosh. So there are
Yeah,
three.
Sutosh, yes.
Yeah, three segments we have. We have something called as a first select, uh, program, which is between three at a family level, including you, your spouse, children, parents, all put together. Between 3 lakhs to 30 lakhs, if you maintain balances with us, you become qualified to take a first select program. Anywhere between 30 lakhs to 3 crores will be a first wealth program, and anything which is 3 crores and above at a family level will be first private. All three, the app, some of the DIY, your relationship manager, all of that will be there. So first select and first wealth, we have relationship managers based out of our branches, and they can help you with some some advice. But if you want a private banking, then you can start with 1 crore, but over time we expect you to reach a 3 crore portfolio for to use services of my team, because they are only 200 people and they manage about 40-50 families per person, so they don't have the bandwidth to manage more than 40-50 families. So we have three programs, as I said: first select, first wealth, and first private, and with three different tiers. But a lot of things are common. So for example, our research and all of that, all three segments can access. But if you want a first private relationship manager to manage your portfolio, then you will need to start with 1 crore at a family level, and over time increase it to 3 crores.
And Rahul, just to add, that this 1 crore includes all kind of investment.
Everything,
It includes
including
debt
fixed
also. So
deposit,
at
savings
time people
account,
think,
mutual
Rahul,
fund, PMS,
yeah,
unlisted, everything.
right. Because at time people will have a perception that this 1 crore is only the equity.
No,
So
no, it's
we look
anything.
at
It
a
could be
corpus.
bonds also. It could be bonds. It could be
Right.
GSECs, anything. Okay. And at a family level, which means you, your spouse, children, everything put together at a family level. Okay. Then the
Okay.
next question was, return is after inflation. No, return is
Adjusted.
always whatever you get is pre-inflation. Fees is, yes, is after our fees. So our fees, we don't charge you separately. Our fees is included in the fees which you pay to the mutual fund. So for example, if you invest 1 crore in a mutual fund and the NAV moves by 10% after 1 year, so 1 crore becomes 1 crore 10 lakhs. My fees, the fund manager fees, everything is already deducted on a daily basis. So the 10% which you see, the return is after my fees and the fund manager fees. Okay, but inflation 10% does not include inflation. 10% is a nominal return, not the real return. Okay.
Okay.
Mr. Vijay Kumar, I
Mr.
think that
Vijay, yes.
that question is answered. Okay,
Yeah.
so
Okay,
already
okay.
I
So
answered.
can
we'll
Yeah.
take
see.
Mr. Arun's question. So
Yes.
it's with Amit ji.
I can see
I
it's a
am a
conservative
conservative.
investor and
Yes.
invest only in fixed maturity like FD. Okay. How can Yeah. So Arun, my reply to your question is firstly, why we are a conservative investor only to invest in equity. One very good example I wanted to tell, and which I always tell to my team, that we have few belief, and Rahul will add on that. One, that what life we are living. Life doesn't mean in terms of the amenities, in terms of the quality of the life, in terms of the facilities, is better than our parents. And what our parent lived is better than their grandparents. And I think I'm a firm believer that our kids and their kids will always live a better life than us in terms of the facilities. So it means we have a strong conviction that the Indian economy will continue to grow. Today we are a 4 trillion economy. From a 4 trillion economy, we are on a path of a 7.5 trillion and then a 10 trillion economy. And we will continue to have a GDP ranging from 6 to 8%. So my belief is that if someone is a conservative investor and is a strong believer that we as a generation to generation continue to grow and the economy continue to grow and don't want to take a high risk, is always advisable to invest in the Nifty. And I always say that the Nifty is something, it is a combination of the top 50 companies. If some of one or two or three companies may not able to perform to the extent of the Nifty expectation, they will come out and the two, three new player will add. So if you see, Rahul can also add that 20-year back, that the 50 Nifty player, today out of those 50, maybe 10 or 15 or 20 may not be there, and the new 20 is there. So I am a firm believer that even though you are a conservative investor, set aside a particular part portion of the money which will invest into the Nifty fund. Stay with that. Will definitely give you a return far better than FD over a period of more than 10 years, because that 50 company will continue to perform if you believe that the India will perform. So that is my view. Rahul, you can also add on that. Maybe I think you are also a believer that the Nifty will continue to perform despite of anything.
No, I agree with you. I think what my view is that there is nothing wrong in investing only in fixed deposits, but there are two things to remember. One, that let's say if your all your life goals are being met at post-tax return of, let's say, 5 or 6%, your portfolio may not outperform inflation, but as long as you keep your lifestyle in check and make sure that that is enough, it's fine. I mean, there is having a good peaceful sleep at night is more important than trying to earn 15% return and having a sleepless night, right? So that's one point. The second, even in fixed income, there are products which are slightly better than fixed deposits, where you can
Right.
earn 1 or 2% more than, let's say, post-tax return. You can get into government bonds, longer term bonds like GSECs. We can help you in buying a GSEC. So if you buy a 40-year GSEC, maybe it will earn you 1 or 2% better than a fixed deposit, because fixed deposit, first of all, is for shorter term, 2 years, 3 years, 4 years, and GSEC is for longer term. So that's one. If you're willing to, let's say, go to a AAA rated bond like an HDFC or a Bajaj Finance, they can also give you a slightly better return than.
Slightly better.
Correct. Or if you're willing to take a risk, let's say you want to buy a state government bond. Okay, like some of our customers are very happy to buy a UP Power or a Andhra Pradesh Power. These are AA rated bonds, state government guaranteed. They can give you 8.5, 9%, and whereas FDs are giving you 7 or 8%, right? So there are ways and means to maximize within the fixed income
Yeah.
also. Not necessarily that everybody has to invest in equities. It's not compulsory. But then you'll have to keep your expectations in check
In the
and make
particular
sure that.
zone. Right. Right.
Absolutely.
And as Rahul mentioned, the most important thing is today, even I have seen in my life that even a 1% impact of the compounding changes your corpus. If you have a return from 7 to 8, 8 to 9, every single percentage will have a significant impact over a period of 25 years in the compounding manner. And next is
Yeah.
Pankaj.
Pankaj, sir, what is PMS portfolio required to associate as investor?
So PMS, I'll take this, Mr. Pankaj.
Yeah.
PMS, as per the SEBI rules, it's 50 lakhs minimum. You can start any PMS with 50. Now there is some new scheme which is coming with 10 lakhs, so that also is there. But 50 lakhs is the current requirement.
Okay, okay. Mr. Vijay is asking, what is your investment advice in the current market situation due to tariff on India by USA?
So it is, we have done an extensive study the last 2 months. Almost all our customers are asking the same question.
Same question.
So two things here. one, we have analyzed the impact on Indian economy. The worst case scenario is 0.5% reduction in the GDP. In fact, if you see the GDP data came yesterday, and it is exceeded, it's 7.8% first quarter of this financial year, exceeded all the expectations, of course, because in anticipation of tariff, people started purchasing and all of that early. Government also spent a lot of money in April, May, June. So that is a temporary thing, but 7.8% is a very good rate. But next 1 year, if nothing changes, we are hoping that some of this may not be sustainable. The tariffs, will find some solution. But assuming that these tariffs stay, you will have a max impact of 0.5%. And there also, the second thing is positive impact of this will be that if you notice India's history, only when we are cornered, we tend to take some reform steps. So this, because of this tariff, you saw the GST reform about 2-3 weeks back. RBI is going to cut rates. We are talking about more reforms. So it is, in fact, industry leaders are telling the government that use it as an opportunity to maybe do some more reforms, which will help the economy. So net, it's a very short term impact and very, very minimal, because our country is not dependent on exports as much as, let's say, a Vietnam or a Bangladesh or a China, for that matter. We are very, very largely a domestic consumption driven economy. 65% of our economy is domestic consumption driven. So it may not have a very large impact. Next.
Just a second. So,
Mr. Sheel Kumar, I think. Yeah.
yes.
12,000 per
Okay,
month
this
mutual
is an
fund. How can I
interesting
earn 2
question.
crore actually?
So I just checked. I just did the calculation. Mr. Sheel, you will have about 35 lakhs at 15% return. If you invest 12,000 for the
Per
next
month.
10 years, you will have 35 lakhs. So for 2 crores, if you want 2 crores after 10 years, you will need to invest close to about, I'm just doing a calculation, about 35,000 rupees per month
Right.
to be able to get to 1 crore in 10 years. So if you do at 15%,
15%.
if you do 35,000 rupees, roughly you will get about a crore after 10 years.
So mix of large cap and maybe mid cap. So.
Yeah, it could be a
It's a
combination
combination of
yeah.
both.
Okay. So the next question is, what is the maximum assured return in percentage that you can offer for a short-term investment?
So our fixed deposit, our savings account is a very good
That's
tool.
7%.
Yeah, you get above 10 lakhs if you keep with our bank account. Then you earn 7%. So that is the guaranteed return, and we pay you monthly interest on that. The fixed deposit also is closer to that, 6.5 to 7%. So that is typically, if you go to any good banks, SBI, HDFC, Axis, ICICI, us, the well-known banks, you will get anywhere between 6 to 7%. That's the range of fixed deposit.
And the great thing I think which you ask is about the short term. So when you talk about a short term, then it means you are projecting that you may need a liquidity at any point of the time over a period of next 12 months. So for that one, our saving is the best product, because 7% you will not get at a short term period with a liquidity available at all time in any other product. So that is the beauty of that particular product, because saving you can withdraw money at any point of time.
Okay.
Yeah.
Next question we have from Mr. Ashutosh. What about the fee except mutual fund?
So in all products, whether it's PMS, AIF, mutual fund, the fees is part of the cost of the fund. So typically, an equity mutual fund or equity PMS, equity AIF will cost you everything put together. My fees, the fund manager fees, all expenses, between 1.5% to 2% is a fees, all inclusive. But whatever returns you see on your portfolio is after the expenses. Okay. And if you go for a debt mutual fund, fixed income, it will be between 0.5 to 1% per annum. Okay, so that's a typical fees. Of course, it varies from product to product, but typically equity oriented products will charge you between 1.5 to 2% per annum, and fixed income will be 0.5 to 1%. These are all SEBI regulated and very transparent. You can see everything on the website of all these companies. on the document, everything is mentioned. So it's regulated. Fund managers cannot charge beyond a certain number. Okay, it's all regulated.
I think the next question would be around the same. What will be the
Similar.
advisory
So
charge?
there is,
Okay.
it's all inclusive, and no advisory charge
Right.
separately. It is all 50 lakh PMS portfolio of equity will be costing you between 1.5 to 2%.
We'll take questions for another 5 minutes. So, this question is: what if Indian market goes into China after cycle after 2008? Their economy become 5 times of 2008, or Japanese index has reached to 1990 level after 34 years, generating negative return for 34
Yeah, it's a
years.
very good question. Very good question, Mr. Baldev. But I'll tell you. So just take a cue from your question. Between 1945 and 1995, Japan was the world's biggest. Sorry, not biggest. The Japan was the world's best performing stock market for 50 years. And it is not a magic, because 1945, of course, because of the war, the country was in ruins. For 50 years, they grew at nearly 8% per annum. Rapid growth. The population was growing, the economy was booming. Every country goes through this period of 30, 40, 50 years of rapid growth. It has happened to Singapore, it's happened to South Korea, it's happened to Germany, it's happened to Japan. It's still happening to US, because US is still relatively younger, it gets immigrants and all of that. So, and what we are seeing in India in the last 30 years, between early 90s and now, because we are growing at 6 to 7% per annum, we continue to have that, economic dynamism, and the stock market is doing well. Eventually what you're saying is will happen, but we still are 15-20 years away from that. Once the country starts aging, after 2047 is what we are feeling, that country will start aging. So once you start aging, like what happened to China last 10-15 years, their population is declining. Japan, of course, last 30 years they are declining. So once your population starts declining, less younger people, more older people, all of that, then you can't sustain a 6 to 7% or 8% economic growth. If that happens to India after 15-20 years, then we will also slow down. Our stock markets will slow down, because ultimately it's a reflection of the GDP. But we still have some time, 15-20 years. So
And the
please,
GDP is expect to grow for at least 15-20 years, because if you wanted to have a 10 trillion, it needs to grow at 6 to 8% for next.
so enjoy this moment. We all should feel lucky that most of our work life has coincided with the economic growth of India. Because if you see our parents' generation, till about 1995, India was growing at 2-3% per annum. And only in the last 30-35 years, we have started growing at a faster rate. And hopefully, we will continue for the next 20 years. Yeah, next one.
Great, sir.
The
So,
same question is Pankaj. Yeah, I've seen that. Pankaj, it's the same thing which you are asking. So PMS portfolio, you can always divide the 50 lakh rupees, maybe a 25 lakh in the PMS, and balance in the mutual fund in the GSEC. So it's possible. But all other these three different class. PMS you can put in one way, mutual fund you can put in another way, and GSEC you can divide in the third way. This is over to you, Rahul. This
Yeah,
15%
last question. So
last
there's no
question.
guarantee, Mr. Ninad, that
no
15%
guarantee.
will continue to give. The reason why we are saying 15%, I'll give you a very simple theory. And it is held well for US for the last 100 years. It's held well for India for the last 30-35 years. And I'm hoping that for the next 20 years, it will hold. Just look at the last 35 years of Indian economy. It's grown at around 6 to 7%. So let's take 7% as an average economy growth, real rate of growth in the last 35 years. Uh, Average inflation for the last 35 years is around 4 to 5%. Okay. So you add this 7 to 5, which is 12%, 11 to 12%. The entire India, everything, agriculture, listed, unlisted, big company, small company, you, me, man on the street, everybody has grown at 12%. Entire India. And you can see that in the GDP from 300 billion dollars in 91, 92. We are now at 4 trillion. So 10 times in the last 35 years, and it comes to around 11-12% growth. Now you come to stock market. The top 500 companies listed in the stock market are nearly 95% of the India's stock market valuation. These are supposed to be the best companies, right? Best pricing power, best brands. So they should grow better than India, because India includes everything. You, me, man on the street, agriculture, unlisted, organized, unorganized, everything. So typically they will grow at 1 or 2% better. And that's around 14-15%. And that's the return of Nifty in the last 30-35 years. And then if you take advice of people like us and let's say invest in some mutual funds, actively managed products, they can give you 1 or 2% alpha. So there are mutual funds in India which have completed 30 years plus, and they have given 18% return in the last 30 years. So this is how it flows: 6%, 5%, then another 2%, another 2%. And that's the logic of 15%. There's no guarantee that the next 20 years will be same. But as I told you, in US for the last 100 years, this logic has worked. They have grown at 4%, another 3% inflation. So there the economy has grown at 7-8% for the last 100 years. Then add another 2% for stock market. So their S&P 500 returns are around 12% for the last 100 years. And then the best performing funds like Warren Buffett or some of the other fund managers, they have been able to give more than 12% over the last 30-40 years. So this is how it works. This logic will not work as Mr. Baldev asked, right? Japan, the last 30 years, the stock markets are flat because there is no underlying growth. There's no 6% there. The 6% is 0.5 there. So you put the best fund manager in Japan, they cannot give you 10, 12, 15% return because there's no underlying growth. So this is how it works, but there's no guarantee. If you want guarantee, then 6 to 8% is what you will get. If you want to willing to take some risk with the hope of making a better return, then a 14-15% is possible over the next 10-15 years.
Thank you so much, sir. And I think let's wrap up this session. It was really amazing to have you both here, and I'm sure everyone present in this session would have the same feedback. Thank you so much. And
Thank you, Bhavna.
Thank you so much
Yeah.
to Bhavna and
Thanks,
India
everyone.
360 for giving
Yeah.
us this
Take
platform.
care.
Thank you so much.
Yeah. Bye, everyone. Thank you so much.
Everyone. Bye-bye.